Hey everyone, thank you for tuning into part 4 of the 100K portfolio challenge. In this video, I'm going to go over some of the specific hedges I used today in what's been very unusual, unprecedented market activity. And I want to do it while it's still fresh in my mind. Now, questions that need to be asked and answered, I will do in a future video. And such questions are, well, why are you using the SPY as a hedge instead of the QQQ or the Diamond ETF or the IWM? Why are you using the SPY instead of hedging individual stocks? And why are you using put spreads instead of just naked puts? So forth and so on. Those questions are very important and they will be answered in a future video. But for now, as I said, I want to go over what I did today while it's still fresh in my mind. Okay, thanks for tuning in. Let's see what happened. But anyway, this morning let's see what time I actually did this trade. Here we go, the 480, 470. I bought 4 of those put spreads, and at the time it was 40-ish dollars out of the money. And this was done at 6:43 a.m. I bought 4 of these. So my timing was fortunate as far as that's concerned, because this was done near the high. So this 48.70 spread was done for $1.60. We can see here I paid $160 for it 4 times. Ends up costing me $649. 16 times 420, yeah, with commissions and fees, so just under $650. And in addition to that, note that I sold 570, 580 call spread, and I only sold 2. I was working on another 2 because I wanted to sell 4 up there. But anyway, the price I sold this 570, 580 call spread looks like just under $1.10, $1.09. With commissions and fees, I got $217 for both of them. So roughly $1.08.5 for each. Anyway, what this did, selling this call spread, and again, I was fortunate with the timing because this was also done pretty close in time to when I did the 4 lot that I bought, 6:52. So not even 10 minutes later, I was able to sell this 570, 580, and the expiration on these, by the way, which I'm referring to, is May the 16th. So we're way up here now. I sold the 570, 580 call spread for what was it? $1.08.5, $1.08.5, and it ended up going out for roughly 60 cents. And the put spread, after the market went down the rest of the day, now this ends up, looks like it went out for roughly $2.75. So we have that. But then, again, note that at the end of the day, we got to 500 noon Pacific time, and spent the next hour declining a bit more. So once this happened, I decided at the end of the day to do one more thing, and what I did was, let me do this. I ended up selling a couple of put spreads, and I went out to the 430, 420 strike, and it looks like I got these for $1.40 and $1.45. So I'll show you what this looks like. And remember, these are all hedges, but I did what I did because I felt I needed to take advantage of the opportunities that were presented to me via the market. The initial plan was not to do this because you just can't predict what's going to happen in the future. But I did take advantage of what was given. So anyway, I sold the 430, 420, and I sold 2 of these. And remember, the put spread that I bought as insurance, I bought 4. So if I want, I can still sell a couple of more, and I'm going to wait to see what happens. Now, what this looks like, I'm going to isolate just these. Yeah, this will be fine. So again, remember, this is at expiration. I currently have a very wide profit tent at this May 16th expiration on the insurance that I currently have for this. Now, obviously, you don't want your insurance to pay off. You want to lose money on your insurance, because if you do, that means that the stocks that you're insuring are doing well, or at least doing decently, you'd think. But anyway, this ended up costing me, initially the insurance was roughly 600 and what? 650-ish? Let's see. 650, cost me 650, but by the time I was through with the adjustments, it ended up costing me 150. And remember, I still have, if I want, I can sell a couple more of these 430, 420s, or if the market continues to go down, I can sell some out a little deeper. And what that would look like is, let's say that well, let me use these to start with. Let's say that I sell two more of the 430, 420 at $1.20-ish, okay? So now the resulting risk profile is the following. Note that out here, it's worth 1,000. In here, it's worth 4,000. And at that point, it would basically be done for free. Let's say that I actually did these for the same price as the other two that I sold. Let's say 140. So note that I would actually, at this price, I would actually have the insurance on for a small credit. And insurance is something that costs money, but because of what happened in the market, I was able to do it for a very low price. And this is actually just one. If I sell two of them, then it will definitely be a bit of a credit. I could actually do these for the insurance. I would be done for $150 credit. So that's pretty amazing, and that is just rare. And that's a function of the absurdity, the volatility of the current volatility that we're going through. Anyway, this is how I have these positions hedged. So I have half of the portfolio in a box spread that's 100 wide, which I did 5 times. I'm not going to get into that right now, but I could have done a 500 wide, one lot, and it would save me a bit of money on commissions and whatnot, but I couldn't pull it off that way at the time. So this is how it was done. And then the other half of the portfolio, that is, I'm using the SPY to hedge the risk. And again, with today's timing, buying the 480, 470 early in the morning when the market was near the highs. Obviously, I didn't know what the market was going to do the rest of the day. I don't know if anyone did, but if they did, kudos to them. Their crystal ball is working amazingly well. And then in addition to buying the 480, 470 for a very decent price, I defrayed a bit of that cost by selling the 570, 580 call spread. And then near the end of the day, what time did I buy the 430, 420? Let's take a look. End of the day, 12:49 p.m. So with roughly 10 minutes of 1 p.m., the market close, 1 p.m. Pacific time, I was able to sell the 430, 420 put spread to bring in some additional credits to further defray the cost of the insurance. Now, obviously, I certainly do not want the market anywhere near here at any point. That would be really bad news. Actually, let's take a look. 430. So where was our recent high? Let me do that. And let's just say the recent high on February 19th was 613. Wow. So 100 and 83 points. 183 points. That is pretty big. 183 divided by 613. 20. Wow, 30%. 430 strike is 30% away from the recent high of 613, and 30% move in the SPY in either direction is, but to the downside, that's awful. There's no other way to describe it other than adjectives similar to awful. That's bad. That's really, really bad. And obviously I don't want the market going anywhere near there. So if I get a chance tomorrow, I'll probably sell a couple more of these, or if the market continues to bleed out, then I might be able to sell something like the 400, 390, or something around this area for roughly $1.50, which will mean that my insurance will actually bring in a credit of a few $100s perhaps. But again, I don't want the market anywhere. I don't want the market going anywhere near this area, because it's really bad news, and that's nothing you want to be a part of. So that's a brief explanation. I hope it wasn't too long, of how I have these puppies insured. And in the next video, I'll get into more detail about using call instead of deep in the money calls instead of stock, which I did with PLTR. Okay, thank you if you stayed tuned in for the entire video. I hope it was helpful. If you have any questions, leave them down in the comments, and catch you guys next time.